Today, we're going to be going over the state of the market and what's going on in futures, what's going on in stocks, and how we want to play these trends and ride some of these big waves. What are we going to be talking about tonight? We're going to be looking at the, of course, general market and saying, are we overbought up here, or is this a simple V-shaped recovery due to the pandemic that we had in COVID-19? The markets fell off real hard, and then now we're coming right back up again. COVID-19, what are the long-term and short-term effects? I.e., is the pandemic over? Can we relax as traders, or do we really need to be aggressive in kind of making these trades and getting in and out of these positions? And I'm going to be talking about what, in my opinion, is a true wave one and a true wave two of this particular pandemic. And I have a different viewpoint than kind of what we're seeing on the news, some of the more basic analysis. And I've kind of gone through some charts and done the math and have an interesting perspective on this. So we're going to talk about that as well. We're also going to toggle over to the NQ. And we're going to take a look at that thing and say, why on earth are we making all-time highs in the NQ? What is going on there? And why have we rallied so far? And do we think it's going to stay up here, or do we think we're going to retreat? Okay, we're also going to be talking about gold. What's going on in gold? We saw a recent breakout in gold futures, and we'll be going back and taking a look at that and saying, all right, how are we going to play this? All right, what is our main objective on gold? We're going to be going through some trade examples, what we've done in the past, what we're doing now, and what I anticipate doing here in the future, and how, again, how to kind of ride these waves. And finally, I'll be going over my outlook for the market. What's my short-term outlook? What is my weekly outlook, my monthly outlook, and then the overall macroeconomic picture, which, in my opinion, is the most important piece of information you'll receive tonight. But we're also going to talk about what we need to do now versus what we think the market's going to do between now and December, because intermediate trends are really the way to successfully catch these moves, right? And then we have a little bonus for you at the end of the webinar here, and give you a kind of a look and an insight into a little more detail about how we can move around here, or catch these moves, if you will. So again, state of the market. What is my outlook? Are we overbought, or should we in fact be up here? Well, quite simply, I believe we're overbought. Okay, if we look at the V-shaped recovery that we are currently in, going back to February, right, when the ES was making all-time highs, and this is the futures. This is ES futures, not the indice. However, the numbers are quite similar, so the basic principle still does apply. But if we are looking at this rally to these highs of 3,400, big dip, over 1,000 points, 1,200 points to be a little more accurate, right? And then we came all the way back up to 3,200. It's only 200 points off the all-time high. Not just, and this is something to keep in mind, it's not just the high and the rally that we saw in February, right? Not just the rally we saw in February. This is the rally and the highest point the stock market has ever been at. And we've have made this really nice, healthy recovery, which is great, which is very, very beneficial to all of us, right? Our 401ks, CC, the production that we're seeing in industry, we're seeing restaurants come back open, etc. But is this sustainable given the current conditions of the COVID-19 pandemic? And in my opinion, it's not. And why is that? So let me pull something up for you that I believe you may find interesting. So in my opinion, the wave one is not yet over, and we are not, in fact, in a wave two situation. And why is that? So if we look at the geography of what's happening with respect to cases being presented and the fatality rate, right? So what we saw in New York with that big spike in infections and deaths, right? Most people consider that wave one. And then when those infection rates have been duplicated, so to speak, in states like Texas, Florida, Arizona, and now California, people are considering that a wave two. However, in my opinion, and based on some pretty simple math, and if we go back and look at pandemics of the past, what we find out is that we are actually still in a wave one. It's just wave one has not yet occurred in these other locales, right? As the states open back up and businesses start to open, we're seeing, an influx of cases and an increase in the amount of deaths in these states. And technically speaking, a wave one is not over until there's a prolonged period of calm, right? And in the United States, we have yet to see a prolonged period of calm. We saw calm and the numbers come down right when this began in, March, April, May, almost into June, but then we saw this resurgence in the other part of the country. So what the takeaway from that is, it wasn't necessarily a resurgence, it was a continuation of wave one. It's just the locale of wave one has moved, and it's taken time to get from point A, B, C, D, etc. So it moved like so. New York and Chicago were two of the main cities here in the States where we saw this initial wave one and where we saw it first, right? So with the country opening back up in these phase ones, phase two, phase three, etc., some of these other states that are opening back up, considering, where they are considering themselves having a wave one completed, are perhaps incorrect, as they are only now getting into a wave one as opposed to a wave two. So, point being, the takeaway from this, and the next question would be, if you're considering it a wave one or a wave two, perhaps that's just vernacular, or the vernacular of, who's presenting this data, or, just let's say semantics. Let's just say it's semantics, like who cares? Well, what would happen is if this wave one does die down, right? And then the market, of course, steadies, which would be phenomenal. A true wave two would not actually occur until a period of calm. And again, that period of calm probably would be in the fall, okay? And then an actual wave two, when everyone relaxed and, we're very laxed and relax on some of the restrictions that have been imposed, then that infection rate could potentially go back up. So as traders, the objective here is to be able to understand how COVID will affect the market. So again, with the semantics aside, my macroeconomic view, and this is really based off of unemployment as well. If you look at the increasing unemployment rate. It started at 15 million Americans, 30 million Americans, 40, and 47. And then if you also look at the unofficial unemployment records, that's up in the 60 million. Okay, so as long as that number continues to rise, I don't see the ability or the chances that the market stays up at these levels. So unfortunately, we won't have this V-shaped recovery. We'll have more of a W. And so I would expect one more dip to the downside going into Q3, Q4 here. Now, again, obviously, I hope I'm wrong. I hope that does not happen. It would certainly be tragic. But from simply looking at the math, that is my overall macroeconomic outlook. However, and this is the bright side, so it's not all doomsday and be scared of this, be scared of that. Right now, there's no argument that the market is going up, right? There's absolutely no argument. We are moving, we are shaking, and we are making highs, coming back from this big dip, and that is great. So from a daily outlook, right, when I sit down in the morning and try to evaluate, okay, where do I think the market's going to move today, right? What we're looking for are pullback levels to get long. Okay, looking for pullbacks, buy here, and then sell up here. And these are simple HVA levels, high volume area or market profile, where we are determining when the market moves, right? When it stalls, this shows us where it's going to stall. This shows us where the market is going to stall. Thus, volume and momentum have changed and decreased. Volume has perhaps decreased, but momentum has really gone down. So those will be our levels of support and resistance, quite simply put. So on a daily basis, we have to take a look at where we have been the past couple of days and then look to see where we're are going to be today. So this is, each block of letters here represents 1 day's worth of trades. So if you're not watching and if you're just listening, that's fine. But what this shows you, and I can just explain it, is going back several days, the market has made new lows, with one exception, two exceptions, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So in 8 of the last 10 days, we've made new lows, okay? With an exception here and an exception here. So obviously we want to trade with this daily trend, with this weekly trend. So we're not going to go ahead and continue to buy pullbacks when the market's clearly sliding down. We're not going to sell pops unless we think the market will continue to slide down. So we have to be flexible. We have to be able to move. Now, on a weekly basis, if we look at the market again from this level, going back to the beginning of June, you can see that we have had these dips, right? And many of these dips can be attributed to the fear that has come out and has been caused by COVID-19. So ultimately, one thing moves markets, and that's volume, right? But what's the most important factor that pushes volume, or what's the most important factor in the market that will push us to move? And that would be fear. That's the most important and most detrimental cause to market movement. So if you can, and that's pretty clear simply by looking at this chart. Let me go back a few more days here. This is when we started getting news of the increasing death rate of COVID-19, right? And since then, we've had kind of these daily spikes in COVID-19 and these daily drops in the equity markets, right? So that's pretty scary. And you'll notice, and this is actually a pretty good example over here. You can see the amount of time the market took to drop from 3,400 to 2,200. And the drop started here, let's call it February 22nd, and ended on March 22nd. So a month, right? How much time has it taken to recover? So from March 22nd till now, right, just past June, it still has not recovered, right? So fear, you can see how fast the market breaks due to fear, and how slow it can rally with optimism, kind of reinforcing the fact or the opinion I have that fear ultimately is the most powerful and detrimental factor into moving the market. Hence why I was talking about COVID and letting you folks know, or at least sharing my thoughts on if we do have a true second wave, how fast the market could break again. And again, we hope this doesn't happen, but in case it does, we want to be ready for it, right? We want to be able to hedge 401ks, businesses, etc., and make sure we're not losing our shirts if the market tanks. So let's take a look. Let's toggle away from that and take a look at gold here and talk about what's been happening in gold. So let me adjust the settings for you. And let's go back 185 days and we'll pull up a little better chart. Okay, so going back until um, 4.6, right? 4.6. We rallied, gold rallied through the 1680 level. Okay, 1680. And ultimately rallied up to 1760. Okay, so what I was doing in futures is every time it came up within 5 points, I would sell 1755s and then look to buy 1685s. So 5 points inside of that. So we did this, and our stops, if you look at the ultimate, so 1755 down to 1685, 70 points. Okay, so we look to use a stop of half that, 35 points. Okay, so our stop is up here, our stop is up down here from when we're going short versus going long. And the first time we put on this trade was after the market went through these 1760s and then got back in here. And you can see we did that once, twice. So sell 1, 2, 3, 4, 5, 6, 7, 8, and then got stopped out on the 8th go round. Okay, so if you're not actively looking to get in, get out, get in, get out on a daily basis, we can have a pretty simple strategy where, again, you have a limit order up here looking to sell, and then a buy order down here, right? So for the sake of discussion, if you sell 1, then you buy 2. You cover your short and you get long. And then if it rallies back up, you sell 1, and then you sell another 1 to bring it back down. You do that over and over again. You just have to make sure that when these orders that are executed, stops automatically go in, right? And this is not something you need to be monitoring intraday, every day, right? The number of trade frequency over the course of time is you enter on 4/16, and then the next fill is until the 20th. And then your next fill is until the 23rd. And then you move into May. And your next is May 1st, Your fill after that is until May 17th. So as long as you have an alert set up, right, either on your phone or in your email, what have you, you'll know what's going on. All right, so that's a nice, easy way to play gold when we have these sideways markets, as we identify these channels. And the next question would be, how do you identify these channels? And I use my HVA chart, high volume area chart. And you can see 1752 is an HVA, right? So 3 points off of the high of the channel of 1755 that we were selling. And we also have an HVA down here at 1695 and 1690. So we're buying right at the bottom of those HVAs as well. So that gives us a little bit more context into where we're pulling these numbers from, right? Those HVAs already exist. We had already traded up here before, right? So we knew where that channel was going to form. And now perhaps we didn't know, but that was our prediction, right? That was our prediction. So that's how we got into these trades, and that's how we were able to stick with them. Okay. Now, next question is, where is gold going? So if gold stays bullish, we'd be looking for another channel up here between 1760 and 1840. So next question, what do we have at 1840? Well, at the moment, nothing, unless we go back even further. So there's not much to the upside in terms of resistance, but if we're expecting it to stay in that same range of a channel, that's where we'd be looking for this to exhaust. Okay, now I've gotten a lot of questions about the NQ. So we've been long a lot of Nasdaq futures lately, and the question I always get is, Joe, where are you determining your exit levels? Like, if we're long, why do we think the market's going to stop here, here, or here? And that's based off of some standard deviations. Okay, so what's the standard deviation of the 21-day moving average? And if the moving average is going up by X, X, X for the past 20 days, we're expecting it to go up X as well, right? So we're trying to figure out what the standard movements are, or what the average movements are, and then simply add that to our entry point. Okay. We're also incorporating some of the round numbers that we see. So 10,000, obviously. When we were trading down here at this, I think we were trading about 99.10. Okay. I had a question, do you think that the market is going to go to 10,000? I said 99.9 delta that it goes, as in 99%. It will absolutely trade 10,000. And one of the reasons that we're doing that is it's that psychological level where we expect the market to rally and to hit those even numbers. Okay. And inevitably it did, right? So we had a few long-term longs, like that we held for a couple of days, maybe a week or longer, but we were also buying dips this whole time. Okay, one of the ways that we were able to do that, and to do a quick trade example here in futures, is we look for these EMAs that you see. So these fast moving averages or exponential moving averages versus slow moving averages, along with the volume weighted average and the CCI. So we have technical indicators that tell us kind of when to get in. Now, I don't follow technical indicators only, right? I want to have a bias. So our objective with these technical indicators is to assist us in entering the market at a good time or a good place. And specifically, we would want both, right? A good time and a good place. And so that's what we use the technicals for, is to help us identify an area where we want to get long, as opposed to just, throwing a dart at the market, at these charts, and saying, oh, that's where I want to get long. So we're not relying solely on technicals or these moving averages or what have you. Our objective and our thought is, okay, if we think the market's going to hit 10,000 and we're trading 9,900, where's our best entry point that will have the highest probability of keeping us in that trade without a big pullback and stopping us out? Okay, and that's where these charts come in, and the math's already done for you. There's nothing to do. It's just a visual representation. So using these charts, a combination of these charts you see on the screen, is how we are able to get into these trades and to ride these big waves. Okay. Quick toggle over to crude oil, as that's one of my babies in terms of trading. My outlook on crude right now is I think we are way overbought in crude, along with many items in the stock market, specifically if we look at some of the futures. But if we look a little more closely at crude oil, the supply in crude, the global supply, although is decreasing, there's still more supply than there is demand. Right. There was this recent agreement with OPEC Plus to reduce 9.7 million barrels per day of oil, but that doesn't even really scratch the surface of the lack of demand. Now, if you look at the EIA numbers that we've been experiencing over the last couple of weeks, couple of months, they are certainly starting to get more bullish, and that makes sense. With stocks railing so hard, equities railing so hard, so there has been that one-to-one correlation. Now, it hasn't been perfect, obviously, and one-to-one is, in fact, somewhat of a stretch. But to illustrate the point, when the equities go up, we are looking for crude to go up and vice versa. Now, something to note is that equities have been leading crude, not the other way around. So if we see crude tank, I would not expect equities to follow simply because crude is railing. On the other side of the coin, if equities fly up 5, 10, 15%, I would expect crude to go with it. So when using that lead-lag relationship, we want the leading vehicle to be equities and expect crude to lag. So if equities rally first, buy crude with the expectation that crude's going to follow that, and then vice versa. If you're looking solely at the fundamental picture of the crude oil suite, and that would be including RBOB, heating oil, and Brent, most specifically Brent, we want to keep an eye on the ARB. So what is the Brent contract trading versus the CL contract, right? And that ARB used to be pretty wide, $5, $10, right? And it has shrunk only to a couple of bucks, right? So what that tells us is the global benchmark of Brent is no longer railing, right? Indicating a slow pullback in demand and potentially indicating that the CL is overbought. So if that ARB comes back in line, we would expect crude to break first. Okay, so we are hitting our time, but something I did want to mention is I am doing a class here on July 11th, okay, for the volume breakout system, the floor trader's secret for catching the biggest intraday moves. So we're going to be talking about the methodologies that I use in order to ride some of these big waves, right? And more importantly, stay out of signals or positions where we're going to get stopped out, where we're going to get chewed up. What are the market conditions that will enable the best risk reward and facilitate a highest probability of success? Okay, now there is a free webinar about this class coming up on Wednesday this week, July 1st at 7 p.m. Central. So I would encourage all of you to attend that. And I'll get a little further in depth with what exactly is going to be in the class, what exactly you're going to learn, and give you a larger and 10,000-foot view of my process and kind of discuss how you can emulate said process on your own. And on top of that, watch me do it live on the 14th, 16th, etc. And I'll be trading in the room. You can follow along with me. You can see my positions, where I enter, where I'm getting out, what my stop loss is, etc. So with that, thanks everybody for hanging in there and listening. Hope you learned a little bit. If you have any questions, comments, concerns, please reach out to support@simplertrading. Thanks for being here. I hope everyone has a profitable day. And again, my name is Joe Rokop, Managing Director of Commodities and Equities. And that is all. Have a great evening, folks.